Something is happening in the silver market right now that the big banks do not want you to understand. And I'm not talking about a minor fluctuation, a blip on a chart that disappears in a week. I'm talking about a structural signal, a deep systemic warning that has quietly been building for months and that is now screaming so loudly that even mainstream analysts are starting to take notice. Most people watching this video own stocks, maybe some bonds, maybe they've got money sitting in a 401k or an IRA, and they have absolutely no idea what silver is telling us about the fragility of the entire financial system right now. By the time this video is over, you will. Let me start by asking you a simple question. If you went to your local coin dealer and you tried to buy silver today, you'd pay around $68 an ounce. That's roughly what it costs right now in the physical market. But here's what most people don't know. There's another silver price, a paper price, a futures price. And the spread between those two markets, between what's written on a contract and what actual silver costs in your hand, has been quietly and persistently expanding. That divergence, that's the warning. That's the signal. And when you understand what it means, you'll understand exactly why the banks are nervous. Now, before I go deeper, if you're someone approaching retirement or already in retirement, and you've been wondering whether there's something smarter you can do with your savings than just letting it sit in instruments that are losing ground to inflation, check the description below. I put together a completely free guide that outlines the saving strategies thousands of American retirees are already using to protect what they've spent a lifetime building. It's down there, it costs nothing, and it might be the most important thing you read this month. But let's get back to silver, because this story goes far deeper than most people realize. To understand why silver just flashed this massive warning to the banks, you need to understand something called the gold to silver ratio. Right now, with gold trading at roughly $4,300 an ounce and silver sitting near $68, the ratio is around 63 to 1. That means it takes about 63 ounces of silver to buy 1 ounce of gold. And on the surface, that might sound like a dry technical number, but it is one of the most revealing relationships in all of finance, and it has an extraordinary track record of predicting what comes next in precious metals markets. Here's the history that matters. Throughout most of human civilization, the gold to silver ratio hovered between 15 and 20 to 1. The ancient Roman Empire officially set it at 12 to 1. The United States government, under the Coinage Act of 1837, set it at 16 to 1. Mother Nature itself produces silver and gold in roughly a 10 to 1 ratio in the Earth's crust. So when you look at a ratio of 63 to 1, what you're seeing is a market where silver has been dramatically, structurally suppressed relative to gold. And history has shown, over and over again, that when that rubber band gets stretched this far, it snaps back violently. Think about what happened in 1980. The ratio got stretched, silver became incredibly cheap relative to gold. And then two Texas billionaires named Nelson and William Hunt saw exactly what was happening. They began accumulating physical silver on a massive scale, buying it on the futures markets, taking delivery, shipping it to Switzerland, pulling it out of the system. At their peak, the Hunt brothers had cornered roughly 1/3 of all the silver on the planet that wasn't already held by governments. And what happened to the price? Silver rocketed from under $6 an ounce all the way to nearly $50 in the span of months. The banks, the exchanges, the regulators, they panicked. COMEX changed the rules mid-game. They moved to liquidation-only trading, meaning you could sell silver contracts but not buy new ones. The price collapsed. The Hunt brothers were destroyed financially. But the moment, that extraordinary moment where the ratio snapped back, that moment proved something fundamental. When physical demand overwhelms the paper system breaks. And here's what almost nobody is talking about right now. The conditions building today are in many ways more extreme and more structurally sound than what existed in 1980. The Hunt brothers were two wealthy individuals with borrowed money. What's happening today is driven by the entire modern economy's insatiable hunger for silver, not as jewelry, not as coins, as a critical industrial input in technologies that are being deployed at a scale the world has never seen. Let me walk you through this because it's genuinely staggering. Solar panels. Every single solar panel manufactured today requires silver. Silver is used in the photovoltaic cells to conduct electricity. A standard residential solar panel contains somewhere between 10 and 20 grams of silver. Now, multiply that by the hundreds of millions of panels being installed around the world every single year, in China, in India, in Europe, in the United States. in developing countries racing to electrify. The solar industry alone is consuming a significant and growing share of total annual silver production, and that consumption is projected to accelerate dramatically over the coming years as nations push toward clean energy targets. Electric vehicles. The average EV contains roughly 1 to 2 ounces of silver in the circuit boards, the switches, the battery management systems, the charging infrastructure. And that's just the car itself. Every EV charging station also uses silver. Every smart grid component feeding power to those stations uses silver. The electrification of transportation isn't just changing how we move. It's creating a new, permanent, massive source of industrial silver demand that didn't exist 20 years ago. And then there's 5G infrastructure. Every 5G antenna, every base station, every smartphone capable of connecting to that network, all of it uses silver in the connectors and circuit boards because silver is the most electrically conductive metal on the periodic table. There's no substitute. You cannot use copper, you cannot use aluminum. If you want the best performance in high-frequency electronics, you use silver, period. Now here's where it gets alarming. The world is producing roughly 800 to 900 million ounces of silver per year from mining. Industrial demand alone, not investment demand, not jewelry, not silverware, just the industrial side, is consuming the majority of that supply, and it's growing. When you add investment demand on top of that, you get a market that has been in a structural supply deficit. We are consuming more silver than we are mining every year. The above-ground stockpiles of silver that used to act as a buffer have been quietly and steadily drawn down over the past decade. Unlike gold, which gets hoarded and recycled at very high rates, most silver gets used in small quantities in electronics and industrial applications, and it is extremely difficult to economically recover and recycle. It goes into a solar panel and stays there for 25 years. It gets soldered onto a circuit board and eventually ends up in a landfill. It is consumed permanently in a way that gold simply is not. So you have a market with growing demand, shrinking supply, declining above-ground stockpiles, and a price that is still, by historical standards, dramatically undervalued relative to gold. And this is what silver is warning the banks about. Because here's what the banks are doing on the other side of this trade. The commercial banks, particularly the large bullion banks, have historically held enormous short positions in the silver futures market. These are bets that the price of silver will go down, or at the very least, won't go up too fast. The Commodity Futures Trading Commission publishes something called the Commitments of Traders Report every week, and for years, savvy market watchers have looked at the positioning of what the CFTC calls commercials, which is largely the big bullion banks, and what they've seen is a persistent, almost permanent, massive short position in silver. At various points, the aggregate short position of the large commercial traders has represented a significant multiple of annual global silver production. In other words, these banks have sold silver on paper that doesn't exist in any physical form, in quantities that dwarf the real-world supply. This is what critics call the paper silver market. On COMEX, for every ounce of physical silver held in the vault, there are potentially dozens or even hundreds of paper claims outstanding. Futures contracts, options, unallocated silver accounts at bullion banks. Most of the time, this system works because most people never actually demand physical delivery. They settle in cash. The game continues. But here's what silver is warning us about. When physical demand starts consistently outpacing physical supply, when the users of silver, the manufacturers and the solar companies and the chip makers, start pulling physical metal out of the COMEX vaults in meaningful quantities, the relationship between paper silver and physical silver starts to crack. Registered silver inventories at COMEX, the metal actually available for delivery, have seen significant drawdowns. When traders attempt to stand for delivery and the vaults can't fully accommodate it, the premium for physical metal over the paper price rises. And when that premium rises, it is the market sending a very clear message. The paper price and the real price are not the same thing. The emperor has no clothes. This is the warning. This is what silver is flashing. And I want to put this in the context of something even bigger, because the silver story doesn't exist in isolation. It exists in a world where the global monetary order is under more stress than at any time since the end of the Bretton Woods system in 1971. Think about what happened in August of that year. Richard Nixon stood in front of the cameras and told the world that the United States was suspending the convertibility of the dollar into gold. Up until that moment, foreign governments could take their US dollar reserves and exchange them for gold at the Treasury at a fixed rate. When Nixon closed that window, he changed the nature of money itself. The dollar became effectively pure paper, backed by nothing except trust in the United States government and the petrodollar system that was quietly being constructed at the same time. And for decades, that system worked because the United States was the undisputed economic and military hegemon. You needed dollars to buy oil. You needed dollars to settle international trade. Everybody needed dollars, so everybody was forced to hold them, which gave the United States the extraordinary privilege of printing money without immediately suffering the inflation consequences that would have destroyed any other country. But that system is now being openly challenged. You have the BRICS nations, Brazil, Russia, India, China, South Africa, and now a growing list of others, explicitly working to reduce their dependence on the dollar in international trade. Central banks around the world have been buying gold at a pace not seen since the 1960s, accumulating physical gold specifically because they want an asset that is no one else's liability, that can't be frozen or sanctioned, that doesn't depend on trust in any government. The de-dollarization trend isn't a fringe theory anymore. It's being discussed openly in finance ministries and central banks from Beijing to Riyadh to Moscow to New Delhi. And when the dollar-based system comes under enough stress, when confidence in dollar-denominated assets starts to crack in a meaningful way, the rush into physical precious metals will be unlike anything modern markets have ever experienced. Now, I want to pause here for just a moment because I'd be doing you a disservice if I talked about all of this without addressing the question that's probably forming in your mind right now. What do you actually do about it? If you have a significant amount sitting in a traditional retirement account, a 401k, an IRA, and you're watching the world shift in the ways we've been talking about, there is something concrete you can do. A gold IRA allows you to hold actual physical precious metals, gold, silver, platinum, inside a tax-advantaged retirement account. It's not a speculative crypto gut. It's not a leveraged trade. It's the ability to own a real, tangible asset with thousands of years of monetary history inside the same type of account you're already using. The mechanics of how to set one up, how to roll over existing retirement funds without triggering a tax penalty, what to look for in a custodian, all of that matters, and it's all navigable if you understand the landscape. With everything that's happening globally, the geopolitical fractures, the currency pressures, the debt levels that governments have accumulated to frankly unsustainable levels, having even a portion of your retirement wealth in physical precious metals is the kind of hedge that sophisticated investors have used for generations to protect against exactly the kind of systemic risks we're describing right now. I'll have more on where to learn about this in just a moment. Let me bring this back to the 1980 parallel one more time, because I think there's a specific detail from that episode that deserves more attention than it usually gets. When the Hunt brothers were accumulating silver, the banking establishment didn't just change the rules on COMEX. The Federal Reserve took the extraordinary step of meeting on a Saturday to authorize emergency lending to the bullion banks that were exposed to the rising price. Think about that for a moment. The Fed, on a weekend, intervening to protect the banks from a rising silver price. That tells you everything you need to know about the relationship between the major financial institutions and the silver market. Rising silver prices are inherently a threat to the credibility of the banking system because they advertise, loudly and publicly, that something is wrong with paper money. And then you had 2011. Silver got to nearly $50 an ounce. The ratio was compressing, physical demand was surging. And again, the exchanges moved aggressively, raising margin requirements 5 times in a matter of weeks. Each margin hike forced leveraged longs to liquidate. The price was crushed from almost $50 back down into the 20s. The banking system breathed a sigh of relief. But here's the thing about 2011 that most people missed. The fundamental forces that drove silver toward $50 didn't go away. Industrial demand kept growing. Mining supply stayed relatively flat. The above-ground stockpiles continued their slow decline. And the monetary pressures, the debt, the deficit spending, the currency debasement, those didn't stop either. They accelerated. The suppression worked in the short term, but suppression isn't resolution, it's postponement. What's different today is the sheer scale of the industrial demand equation. In 1980, silver was primarily a monetary and photographic metal. Industrial photography was actually a huge consumer of silver at the time. But digital photography arrived, and that demand went away. And silver's price went mostly sideways for years because the industrial replacement didn't materialize fast enough to fill the gap. But now, solar energy isn't going to be replaced by a digital alternative. Electric vehicles aren't going away. 5G isn't being rolled back. The industrial demand base for silver today is more diversified, more deeply embedded in the global economy, and more structurally durable than at any previous point in history. You also have to consider what happens when retail investors and institutional money managers start paying attention to the gold to silver ratio at the same time as the industrial demand picture crystallizes in the public mind. Silver is a small market, genuinely small. The entire above-ground investable silver supply is worth a fraction of what flows through global equity markets in a single day. When significant capital starts rotating into silver, and history suggests this rotation happens suddenly, not gradually, the moves can be parabolic. Consider this. If the gold to silver ratio were to normalize, even to 50 to 1, not to the historical average of 15 to 1, just to 50, with gold where it is today, that implies a silver price well above $80 an ounce. If it normalized to 30 to 1, we'd be talking about prices that would rewrite the record books. These aren't fantasy numbers conjured from thin air. They're basic arithmetic applied to a reversion to historical mean. The question isn't whether the ratio normalizes. It has always normalized. The question is when and what triggers the compression. And right now, the trigger is arguably sitting right there in plain sight. Physical demand is exceeding physical supply. The paper system is showing stress fractures. The monetary environment, with debt levels, deficit spending, and currency debasement reaching levels that make the 1970s look tame, is exactly the kind of backdrop that has historically launched precious metals into major bull markets. And silver, as it has done in every major precious metals bull market in history, is set to outperform gold on a percentage basis once the move gets underway. The banks know this. They're not stupid. The people running the bullion desks at the major financial institutions understand exactly what the chart is saying. They understand the physical market dynamics. And the fact that they maintain these enormous short positions isn't because they believe silver is overvalued. It's because they have structural incentives to keep the paper price contained for as long as possible. But markets have a way of eventually overwhelming even the most powerful institutional participants. The history of commodity markets is littered with examples of coordinated short positions that ultimately broke under the weight of physical reality. That's the warning silver is sending. It's not a warning about silver itself, it's a warning about the entire system of paper claims, fractional reserve finance, and currency debasement that has been the operating system of global finance for decades. Silver is the canary in the coal mine that has always detected monetary stress before it shows up in mainstream markets. And right now, that canary is singing at the top of its lungs. So what do you do with this information? At a minimum, you pay attention. You understand what's happening, because most people around you don't. You think seriously about whether your savings and retirement assets are positioned for the kind of monetary environment that this data is pointing toward. And you do your research, because the worst financial outcomes in history have been suffered by people who didn't see what was coming. Not because the information wasn't available, but because they assumed someone else would warn them in time. Nobody is going to call you and tell you to act. The banks aren't going to send you a letter. The news networks aren't going to run a special report telling you to protect your retirement savings before the system resets. You have to decide, for yourself, that you're going to be ahead of this rather than behind it. If you're someone with $100,000 or more in any retirement account, a 401k, a traditional IRA, a SEP IRA, anything, and you've watched this video through to the end, I want you to know that there is a free, no-obligation educational resource available specifically for you. In the description below, you'll find information about an exclusive one-on-one web conference. Not a sales pitch, not a recorded webinar, a real conversation where you can ask every question you have about how precious metals fit into a retirement strategy, what a gold IRA actually involves, and what options make sense for your specific situation. This is only available to American retailees with at least $100,000 in retirement savings, and it's being made available because the people offering it believe that the best clients are educated clients. You watched this entire video. You did the work to understand what's happening. That commitment to understanding is exactly the kind of mindset that this resource is designed for. The link is in the description. It costs you nothing to learn. Silver just sent the banks a warning. Whether you hear it too, that's up to you.